here today. Good to see everybody. Today I'm going to hit through real quick the presidential cycles. We're going to revisit that as we talked about, every month this year, and it's been following pretty well. Although June didn't follow as much as I would have liked to have seen, but context, it's interesting, and we'll see where we can go from there and where historically the markets tend to go. And then we're going to look at volatility, and there's really not a lot of sign of fear right now. We're going to look at the current money flow stats that I go through every month just to give you a good sense of where the money is. If money's flowing into the market, the market goes up, and the market flowing out, that's usually the problem. And so we'll look at that. And then where the Fed rates should be right now, they probably should be lower, and I'll show you why I think that is. We've covered that before, but I think it's worth revisiting as we're hearing a lot of bickering about where we are with that situation. So let's dive into the seasonality of the first year of the election cycle. I've been looking at this every month so far this year, and it's played out surprisingly accurate, with the exception of this. June was expected, and it historically has a rough time, really, for the whole month. And it really just kind of had a sideways grind. It did go up a little bit here and there. We did get this end of the month rally just like that, but it was really more of a sideways and then up rather than a down then up. And then earlier this week, we did have a bit of a pull off, but nothing like what's showing here. But typically, the second half of July is pretty good in the first year of a presidential cycle. But what happens in August, September is usually less than ideal. So that's something we're going to be thinking about a lot once we get into the end of July, and we can have a better sense of, is money going to start coming out of the market? And if that does, we start seeing agreement in these factors, then we'll certainly want to be taking action. But for now, things look pretty clear, pretty calm, pretty cool in the market environment. Another way to look at this is the VIX index. As of last night, it was 15.94, so 16. When the VIX is at 16, the expected movement of the S&P 500, the broad index, is expected to be only about 1% up and down on a typical day over the next month. Now, when things got crazy, we were up here. When it gets to 32 and higher, expectations or moves are going to be 2% or more over the month. So volatility usually comes in when the market's down, not when it's going up. When markets go up on low volatility, it goes down on high volatility. So with the market volatility right now being pretty low and pretty calm, there's really not a whole lot to worry about right now. The market's probably going to keep grinding up. We might have an ugly day here or there, but on Monday when we had the market down, it was only 1%, a little less than 1%. So that's not really much to get scared of or to be concerned about. It was just, that's a little bit normal. And certainly where we are with the volatility index, that was right in line with what was expected. And then we've just bounced from there. So there's really not a lot of fear in this market right now. But that's another thing. If we get a spike above this 20 line, it's something that I kind of watch consistently. Is if we get a push above there, it might be time to take a little bit of a break, be a little bit more defensive, but we're just not there. We're just not there at all in a good spot. The money flow index on the long term, the advanced decline, is above both moving averages very steadily. It's really not even tempting, where the first half of this year was just an absolute mess. Even when the market was trying to do okay, it was just up and down and up and down. We had a little sell-off in March, and then the April thing, of course, was pretty ugly. But even before that happened, the money was just really not sure what to do below this line. So I thought that was an interesting thing. But since that second fall off after the tariff tantrum, money flow has been pretty steady and back, and nobody seems to care anymore. And I know we were supposed to have news this week of the 90 days expiring on the tariffs. Didn't seem to matter at all. And I said that in another commentary I did this week, and I had people thinking that was going to be wrong, but no news isn't that scary. When we know a deadline is going to happen and then it does, that's really not a big deal. But, it's the unexpected that creates the problems. But for now, volatility is low. There's not a lot of fear. Money's coming in the market. There's really not a lot to be afraid of other than just being invested and wait for the next event to come around and shake things up. But there's no sign of that right now. We did get a little bit of a sell signal, or at least a weakness. We now monitor when money flow falls off of a peak. We did see that earlier this week, but it's really just kind of grinding sideways. We're not really seeing it continue. So I want to watch this. It did peak high enough. This could certainly reverse and get a new high. So I'm not too concerned about this. If this falls back below the 0 line or even below the 200, I might be concerned or thinking about it. But for now, it's an early sign of something could be up, but market doesn't seem to care. Market does not care at all about what the money flow is doing. There's no fear. Just doesn't agree. Broad indexes, the strong ones, of course, the S&P, small cap, mid cap, NASDAQ, and Dow, those are all trending. They've got the ADX trend confirmed. So trend is up on a lot of the broad stuff. Where the weakness is Japan and China. Those are both weak, both on what side of this column they are and their MACDs. They're below their trend. The Asia's having a bit of a troubling time, but even emerging markets starting to roll over. That could be an issue we want to watch for, but developing just turned positive. So it's very mixed, a little bit all over the place, but domestic U.S. broad markets are are fine. There's really not a lot of concern there. And now, earlier in the year, the international was really where the strength was, and that's fallen back. We saw the emerging markets and developed be just, and Japan and China, they were all the strong side while the US was weak. So we've seen this shift back into that situation where it's really domestic US is where you want to be again. And it might be small cap. Small cap historically does do pretty well at this time of the year, this in these cycles, in these election cycles. So that might be a place to be watching. Although I don't trust small caps. It's a very volatile place to be and doesn't usually over a long term offer a whole lot. And you're usually better off being like in a NASDAQ, in tech and NASDAQ, that kind of stuff, and the S&P versus those other names. The sectors, so I like to dive into the S&P and see like where are the sectors going. We've got industrials, technology, big shock, basic materials, energy, those are doing all right, and financials. Financials and tech are what you want to see really pushing. They both got this positive trend going, so there's really not a lot of things to be concerned about. I'd love to see XLC, that's communications, that's like another piece of tech. I'd like to see that a little bit stronger, but so far so good, although it could be rolling over. I think today might undo that. And then, of course, on the weak side, we've got the defensives, the consumer staples, real estate, utilities. The one standout is XLY, but that's getting hit because Tesla is a big part of that index, although it's positive and above a trend. So it may be shifting to the positive soon. So the environment within the S&P, within the index, is not that bad. I mean, you want to see the offensive names leading and the defensive names lagging, and that's exactly what we're seeing here. I mean, I'd love to see them all push positive, and then you can really dive into the market. But there's really not a lot of reason for that, but there's enough to be not concerned about where the market's going. Looking at RRGs, though, I will say these are starting to look tired. They're starting to roll over a little bit. This agrees with that red dot we had a couple of slides ago, that money flow could be weakening, but that doesn't necessarily mean the market's going to crash or fall. It's just be taking a break for a while, right? So we've got all these leaders like technology. There's the XLC, there's communications. Financials are really rolling over there. Real estate's looking ugly, although energy's trying to come back. They're all grouped here and rolling down. That's usually a sign of a pause or maybe in a short term. So we could have a week of weakness, going through mid-July, and then we have that run that we were expecting. Anyways, ideally, I love to see them all shift and move down into here and then do this kind of thing, but turning upwards into the blue. That's when the magic happens. That's when the big runs happen, or you can cover a lot of ground very quickly. But this run has been good and we've taken advantage of it, I think, as much as we could have reasonably. So now is a time of, okay, there's not a reason to dive in more. I mean, we certainly are getting requests of saying, hey, the market's good, we need to get more invested. I'm like, not when you're seeing this. You want to wait for this to take a break, come back into the yellow, even better into red, and that's when you want to get aggressive for this next wave. Right now, you're just buying at the peak if you're diving in too aggressively. So I'm always cautious about that. And then real quick, I'll show the Fed funds rate. This is Tom McCullen's chart showing the 2-year note yield versus the Fed funds rate, and 2-year yield is really where they should be. So it's funny hearing the political arguments about that. Trump wants to cut it. The Fed seems to want to stay still, more in defiance than anything, it seems like. But really, when you look at the 2-year, it should be cut by about 0.5%, which is typically 2 rate cuts. I think his quote was good here. It's Professor 2-year says that the FOMC is a 0.5 point too high right now. They create problems when they think they are smarter than he is. So the Fed is usually late to this party. So I think that's where they are again by about 0.5%. So we're going to be watching that, and rates should be coming down in the near future. But that's also bad for savings accounts and CDs and things like that. So that also could be pushed into a risk asset, but that's a story for another day.